Thanks very much, Rajat, for joining in. Good to have you with us here. Is there any other possibility apart from a 25 basis point hike later today?
Hi, Prashant. Morning. I don't see. I see very little possibility of any change from that. Why? Because the Yellen and the Powell Fed over the last few years have never surprised the markets. I mean, this is what we looked at very closely. And if you go back to what the market was pricing 2 days before Fed decision and what the Fed delivered, it's the same line. You can't even tell the difference between the two. So no surprises are expected based on what they delivered over the last several years.
Okay, Rajat, hi, good morning. So I think the market positioning right now is everyone's poised for a pretty sharp recovery because they're expecting the Fed to be fairly benign, even if they deliver 25 basis points. And then the positioning seems to indicate that it's up from there. Would you concur? Do you see it playing out that way?
Now, this is where the forward guidance comes in, right, for what Powell says. And I agree with your point that they will try to reassure markets, and they have done a lot. If you see what the central banks have done in Europe and in the US, it's dramatic. The way they came in to backstop depositors yesterday, Yellen almost confirmed that they are standing by to guarantee all deposits. Now, interestingly, I must add here is that a lot of what we've seen in Europe and US is playing from the playbook of Indian regulators. What Indian regulators did in the past by banking failures, we've seen 4 in the last 2 decades, is exactly that. They went in with the support, they reassured depositors. Depositors were not harmed. The shareholders were, of course, written off. And this was not the case. Mind you, these are important changes happening in US and European regulatory industries. We have heard time and again from Europe and US that you have the moral hazard. But this time, I think they've learned a few things. To your point about learning from past mistakes, they've learned from the global financial crisis, and to some extent they're taking out the playbook of some of the Asian regulators here and guaranteeing the deposits. So liquidity crisis that we saw is being eased significantly. In fact, you saw last week, in recent days, the U.S. banks have availed of the facility so much that they've availed of that facility to the highest extent since the global financial crisis. So they've gone in and got themselves as much liquidity as they need. So that's a big change that is happening. So going back to your question, we'll need to see what Powell says any more to that. There are challenges. The commercial real estate market in the US is a big risk, and the small banks are heavily exposed to the commercial real estate. So that's one big risk we need to watch.
All right. Hi, Rajat. Good morning. What about the approach to the Indian markets? Last time we chatted, you were talking about it's a good time to buy bonds here in India. What is the asset allocation strategy out here and the approach to the Indian equities as well?
Yes, Nigel, bonds will be a favorite this year. Where the interest rates are, where RBI is in its rate hiking cycle, bonds will be favorite. But equities have drawn down a bit. If there is a recession, and we see increased chances of a recession in the US and Europe after what has happened, I can tell you a few more indicators that we've seen on that, then there is further downside to global equity markets, and India will not be unfazed from that. So why we believe that the chances of a recession, global US and Europe recession has come forward is a few things we're seeing. US money supply is starting to contract. We already had the leading indicators pointing to a recession, but of late we've seen the bank lending standards shoot up. If you measure financial conditions based on actual conditions on the ground, including lending standards, money supply, credit spreads, and together, it's a big, sharp, tightening of financial conditions. So all of that has changed. In the job market, which was the one which was holding up the US economy so far, the leading indicators of the job market, such as temporary help services, those are the early indicators. We know the unemployment rate is a lagging indicator, but temporary help services, companies stopped hiring temporary workers the first thing when they see signs of trouble. That has started to decline. And then you have the first year-on-year rise in initial jobless claims. Initial jobless claims have risen 4% almost year-on-year. You wouldn't see that when you see the long-term chart, but year-on-year it started to rise. Those are the first initial signs. The job market is also cracking, and we know that in the industries such as tech and finance, there's been a heavy shakeout there.
I take your point, Rajat, and another piece of data caught my eye, and that's the US housing market. February this year has been the first year-on-year decline in house prices, and I think over a decade. And that really stayed with me. Now, that's what I was telling Prashant earlier. Let's just hope that it all remains good. It doesn't go south from here. But very quickly, your view on India and how would you approach this market? Anything you like here?
Yeah, we would be pretty defensive in India. Large caps, the defensive sectors, that's the way to go. Long term, as I've kept repeating in this forum and elsewhere, is that in India, the long term story is secure, right? But because everything that you see going around here, it's almost like India is a class apart in that sense. You have the growth story going well. You have the EPS story going well. India is a defensive market. India is a domestic, inward, domestic-driven market. So even if there are problems in US and Europe, India is a safe harbor. If you ask me, there are issues with valuation still, and which is why we prefer within Asia places like China and elsewhere. But the long-term investor story still remains intact for India. So, I wouldn't buy necessarily equities here. Bonds are still going to be the favorite over equities. But, another maybe, 5-10% drop, and we start averaging from there in India.
Got that, Rajat. Thanks very much for the updates there. We'll look forward to chatting with you again soon. That's, of course, the outlook coming in from Stan C. Prashad, I didn't want to say it, but then with Rajat mentioning it, I put it out. I chose not to talk about the negative, but it was a statistic. I mean, the decline year-on-year in the housing, this is overall housing prices in the US.
Yeah.
It's only a 0.2% decline, February 23 over the previous year, 22. But it is the first decline in a decade. And you're right, a lot of us are colored by 2000, 2008, 2007, 8. Anything happens on housing, suddenly you sit up and take notice.
I'll tell you, people who started their career in 2000, I always say 2006, 2007, they saw very little of the bull market and they saw all of the downside, right? And how you start, kind of affects pretty much, affects you for a long time, right? Because if the shock is so large as the global financial crisis, you kind of are always looking over your shoulder saying, well, when is the next one hitting us? But all right, enough of the history lesson. Let's quickly take a quick break here. Our list of top stocks to watch is lined up. Our team will be joining in with a quick view on things, the stocks which will move up and down in just a bit.